We're in the middle of what some are calling a historic time in the history of US government bond pricing. Remember, investors choose to buy bonds for several or all of these reasons: capital preservation and appreciation. Investors usually get their money back or more. Now, most bonds also provide a steady income or coupon payments. And it's a potential hedge against the inflation or a slowdown because investors still get a fixed income. Now, yields have risen to highs not seen since 2007. Last week, the 10-year Treasury yield surged to 5%, the 30-year yield just as high. Now, yields are elevated because the US government has a persistent fiscal deficit, and this is leading to a funding problem. Public debt has risen past $32.3 trillion this year, and it's nearly 120% of total gross domestic product. So the market is pricing yields higher to entice more investors to lend the government more money. With the escalating budget deficit creating a greater supply of bonds, more than demand can meet, US Treasuries are becoming less attractive for foreign investors. Now, so far this year, the BRICS alliance has already dumped $123 billion in US Treasuries to bring down the US dollar. And the US Fed, who was previously a major buyer of T-bills, is also out of the market after it ended its quantitative easing in March last year. The situation is made more serious because it is unclear how high interest rates may have to rise to tackle inflation. Investors have woken up to the reality that we'll be living with a higher interest rate environment for a while longer. Adding to inflationary pressure, there is already political uncertainty hanging over the fiscal deficit in the US. The rise in energy prices and labor unions' wage negotiations aren't helping. The jump in interest rates has rekindled talk of so-called bond vigilantes. That's a term coined by economist Ed Yardeni to describe bond investors who punish heavy spending governments by selling down bonds, thereby driving yields higher. Now, in the 90s, concerns over US federal spending pushed Treasury yields to 8%. Mr. Yardeni himself has chimed in. He writes in an opinion piece for the Financial Times that the vigilantes have been challenging US Treasury Secretary Janet Yellen's policies and could threaten to create a debt crisis. Others believe that the vigilantes won't be able to push around the $25 trillion Treasury market. The higher yield effects have spilled over to Europe and Japan, who are still clinging on to rock-bottom interest rates. The Bank of Japan is an outlier, keeping rates at minus 0.1% and setting a 1% ceiling for 10-year JGB yield. This is, in turn, led to authorities spending some $15 billion in the past few weeks in defense of its cap and currency. The Japanese experience may portend to a tumultuous bond market in the coming months ahead. For CNA Explains, I'm Roland.